Welcome, Stephen. I'm looking forward to speaking with you today about the economic indicators that influence global financial markets, client behaviors, and how we as advisors can understand these and communicate them well to our clients.
Well, thank you very much for having me, Julia.
To start with increased market volatility, rapid changes in the global environment, how can an advisor possibly keep on top of everything?
Well, I think first and foremost, as a busy financial advisor, it's important to realize what your limitations are. The number of tasks that you have in your day, whether it's speaking to clients, dealing with transactions, tax planning, financial planning, it can all add up. So to stay on top of all of the global markets and asset classes can be quite challenging. I think what's important is for advisors to develop a dashboard that they're comfortable with and that they're familiar with, that they can refer to on a regular occasion, but more importantly, be able to explain clearly and plainly to even their most sophisticated client or their least sophisticated client. What I've found in my experience following global financial markets is that the rule of 80-20 exists. It's very important to get a high-level sense of what's going on in the world and have an early warning system, if you will. If there's something that requires more research, there's always more information available, but being able to set up something that you can check on a regular, routine basis, almost a checklist or a pre-flight checklist, if you will, is very important as a financial advisor to keep on top of things, ideally before your clients come to you with the questions. The last thing I would say is that keeping a long-term perspective is, of course, important. We always talk about thinking long-term in our industry. And the reality is that when it comes to market data or developments, there are very few things that happen in economics or markets that can impact the state of the world over the next 3 to 5 years in a single day. It's better to be careful than fast when it comes to making decisions over financial data.
So what are the most important things that advisors can keep on top of?
Well, Julia, what I try to do is I try to break things down into pieces. And the 4 most general buckets, let's call it, that I try to sort pieces of market or financial data into fall into one of 4 buckets. And they're very simple: economy, policy, valuation, and behavioral. And behavioral is a catch-all for a number of different things that can include everything from market technicals to market sentiment to asset flows in between global markets by institutional and retail investors. By lumping all of the different information into these 4 buckets, it's easier to understand how they interact and, more importantly, which ones might have more of an impact over your investment horizon timeline and what might impact your investment portfolio.
So can these 4 buckets tell an advisor what to expect for the year ahead?
Well, I think it's important to note that there's no silver bullet or magic 8 ball. So you can have the best charts in the world, but unfortunately, the world being what it is likes to surprise the smartest of us at the best of times. What's important is to make sure that things are happening the way, A, that you expected them to, but more importantly, B, in a way that makes sense. Looking for disconnects between the areas of the economy or policy or valuation, or even something as simple as investor sentiment. Finding things that don't make sense when you try to connect those dots, that's really what you need to pay the most attention to. The things that happen as per routine, that's the thing that keeps the market moving over the course of years and decades. It's the curveballs that we're looking for. So what we're trying to do is we're trying to paint a picture based on what we know today, but more importantly, what makes sense based on what we've experienced in our past. There's a saying in our industry that history doesn't repeat, but it certainly rhymes. So what we're looking for is what's familiar, but more importantly, the things that are completely unfamiliar. Because it's not what you do know that gets you in trouble, it's what you think you know that gets you in the most trouble.
So let's walk through each one of these buckets and look for those things that rhyme and don't.
Okay, well, let's start with the economy. Global growth has slowed from its peak following the rebound of the global financial crisis, but it's still projected to keep running at a very reasonable 3.5% to 4% on a global basis. When we look around at the major regions of the world, there's certainly been a divergence to date in between the U.S. and the rest of the world, and certainly the emerging markets, and a lot of that has been driven by the dominance of the U.S. economy on a number of fronts. One large impact has been the U.S. tax cut that came into effect at the beginning of 2018, and we saw close to a 28% increase in realized earnings per share. And that was what we referred to as a sugar rush for the market, but it wasn't necessarily something that flowed through to the U.S. economy. Now, heading into 2020, we're seeing that sugar rush fading off, and we're expecting a slowdown in the U.S. economy, but we're still expecting a fairly reasonable positive rate of growth. So the dynamic isn't one such that the world is slowing down, but more that the rest of the world is playing catch up to the head start that the U.S. had in 2019. We're expecting, and when I say we, I'm referring to the World Bank study that came out recently, they're expecting an acceleration of emerging markets to catch up, and that's for a number of reasons. What's happening in the economy, whether it's industrial production, global demand, we'll talk about trade wars. A lot of these things are going from the front view to the rear view mirror, and all of these are good signs for global growth continuing into 2020 and more supportive of risk assets, namely equities.
So with the U.S. as the largest market that we're really looking at, what are some of the things that you're considering?
Well, there's a number of factors to be considered when looking at the U.S. economy, and everybody's looking for leading indicators. And one of the probably most popular, most talked about leading indicators through 2019 was what we call the slope of the yield curve. And just very basically, that's the difference between the long-term interest rate, the 10-year bond, and the short-term interest rate. And that can be measured by the 2-year bond or the 3-month Treasury bill. There are different curves that are looked at. But specifically what people were most worried about is called an inversion, and that was probably one of the most searched words on Google in financial markets for 2019. Because what we saw is a flattening of the yield curve, and that inversion is when short-term rates are actually higher than long-term rates. So think about that very simply. That means people are willing to lend you money for 10 years at a rate cheaper than they're willing to lend you for 2 years or 3 months. Doesn't really make sense because time is a measure of risk when it comes to lending money. Now, the reason that people were so focused on this inversion is that historically the inversion of that yield curve, when you see that 10-year rate drop below the short-term rate, that has historically been a very good leading indicator of the onset of a U.S. recession. Now, it's not a fire alarm indicator. It's not like the recession starts as soon as that inversion happens. Historically, there's been a lag of anywhere between 6 to 18 months, depending upon other conditions in the economy. But everybody was on the lookout for this inversion. And unfortunately, in about September, it happened. So obviously the alarm bells went off, the inversion has come, everybody wants to be ahead of the market. So there was a fear that that would start a cascade effect. But the question that people need to ask is not what happens. Everybody can see the yield curve every day. The question is to ask, why did it happen? And that brings us to a very important question is, why shouldn't we worry about it this time? We're not particularly worried about it, and a lot of market observers also share this sentiment, is that there's a number of things that are different this time. And I know that's a scary phrase when it comes to financial markets, but when you look at why the yield curve inverted this year, there were a number of things going on. First and foremost, it happened about a day after the German 10-year bond yield fell below zero. So that's a negative interest rate. Let me put that in context for some advisors. If I were to loan you a mortgage at 0%, or in fact minus 10 basis points, how big a house would you buy?
As big as possible.
Exactly. So the fundamental laws of gravity when it comes to interest rate have somewhat been repealed. We used to think zero was the lower limit. Well, now with low interest rates, negative interest rates in Europe and in Japan at the policy level, that's leading to a very low environment overall. So the 10-year yield was low to begin with. When that German bond yield fell below zero, the US 10-year bond fell. So it wasn't that the short rate was going up. In fact, the Federal Reserve has been lowering rates through 2019. It's just that people were so concerned over the impact on global growth that the risk premium on 10-year bonds fell. And we had that inversion. Now, the curve that most people look at is the 10-2 year, which inverted for a very short time period. I believe it was only for a couple of weeks before it re-inverted. Now, what's all this to say? What's the impact on the global economy? There are too many other green flags versus this one red flag. So this gets to one key point. No one chart is a silver bullet. When you find one thing that gives you an idea of where the market's going, that means do more homework. Look for confirmation when it comes to a data point. One data point is just a point. It doesn't go anywhere. 2 data points is just a line, and that means that things will continue going in the same direction. We know that's not true of global economics or markets. What you need are 3 data points at a minimum to see a curve, and that tells you whether something is accelerating or decelerating. So when we look at the U.S. market and the economy, just because the yield curve is inverted, that made us do more homework and say, well, why do we believe the U.S. economy is going to continue to be strong into 2020?
So I've heard a lot of talk about global manufacturing being sluggish over the last year. Is that a real concern?
Yes, manufacturing has been an issue over the past year. Part of it has been driven by a slowdown in the economy, which has been triggered by a fall in global trade as a result of the U.S.-China trade negotiations. But when we look at a metric called the Purchasing Managers Index, there's a number of things that we can see. That index is made up of several different components, including input prices, employment costs, new orders, future expectations of businesses. And the way those indices work is basically when you're above 50, it means the economy's growing. When you're below 50, you're in contraction. And a lot of people have been very concerned, as you can see from a couple of charts that I've brought today, that over time, those indices have fallen significantly in Europe, a little bit in the US, but more so emerging markets as well. We've seen those drop below their previous highs, and people are concerned that with less manufacturing, that must mean that the economy is slowing down. What's important to know, and again particularly for the US, is that manufacturing is less of a component of the global economy than people might think. In the US case, when you look at the PMI composite, it's a combination of manufacturing and non-manufacturing or services. The manufacturing component is only about 25% of the total. So what that means is that even though you might have a downturn in manufacturing, that's not necessarily a contraction for the economy. If you look at the chart focus on the US, you'll see that the services line is actually more correlated to the overall composite. What does that mean? It means that the US economy is less cyclical than it was 30 or 40 years ago when we were manufacturing focused. The other thing that it means is that people tend to keep their jobs a little bit longer through the ups and downs of the economic cycle because we do have more of the economy focused on services. And that can include services from retail to vacations, to consulting services, accounting services, financial planning services, all of these things that lend to a greater stability over the long run for the U.S. economy.
So we've talked a little bit about the U.S. here. I've heard concerns about manufacturing in Europe. Could you tell us a little bit about that?
What people have been concerned about is certainly Europe. Now in Germany, manufacturing is a much larger part of their total economy, and we've seen that reflected in their overall GDP growth. The good news is that those PMI indices seem to be bottoming out. We seem to be seeing an upturn in many markets, including emerging markets, particularly emerging market Asia, and we're getting back above that 50 level. So when we move back above 50, that means we're resuming expansion. And it's very common over an economic cycle to have small contractions in PMI. It's the long sustained ones that can be damaging to the economy. Fortunately, it doesn't look like we're seeing that. So when we look at global growth around the world and what's heading into 2020, the PMI indices are somewhat reassuring. Obviously, we'd like them to be higher, but again, it's about direction and where the market is growing.
And how does employment fit into this bigger picture?
Employment is one of what a lot of people refer to as the 3 golden eggs of the U.S. economy, and that would include employment, housing, and cars. Employment has been one of the driving forces of the U.S. economy, and also one of the biggest mysteries over the past several years for the economic growth. If you look at employment growth, we had a print that was a little bit below expectations, but again, that can be attributed in any one month to a number of different factors. It could be the weather, it could be a labor strike, it could be a single company that stopped production for whatever reason. All of these things boil through to the final number. What's important to look at is the trend. So looking at the 6-month average, you can see that we're still tracking somewhere around 140 to 150,000 jobs per month being created. That's new jobs being created in the US. When you think about a 10-year economic cycle to still be tracking at that level, that's fairly impressive. We also have an unemployment rate of 3.7%, which is low as it's been in several decades. So to think that the U.S. is in a situation where employment is becoming a problem, that people are starting to lose jobs or not able to find work, that's just not true. And it doesn't look like we're anywhere near getting to that point. It's not just people finding jobs, but it's also people making more money at the jobs that they're at. And that's been the mystery part that I was talking about. If you look at wage growth over the past several years, you would think that at 3.7% unemployment, wage growth would become a problem, we would have higher inflation, and that would force the Fed to be raising rates, when in fact they're lowering rates. So the employment front looks very strong in the U.S. One of the measures that we look at is actually the number of people that aren't employed, and that's the initial jobless claim that comes out weekly. We look at the 4-week rolling average of initial unemployment claims, and again, it can be bumpy from week to week, but what we found is that historically, until it jumps up to about 350 to 400,000 people that are newly unemployed on a 4-week rolling average, that's typically when you need to start worrying about the economy slowing down because people can't find work. That certainly hasn't been a problem through 2019, and looking at the levels today, it doesn't appear to be a problem going into 2020, unless something radical happens.
So let's talk about that second bucket of policy now. What does that entail?
There's 3 main types of policy that you need to worry about. There's monetary policy, fiscal policy, and government policy, just general rules and laws that might impact a market or a sector. Monetary policy has certainly been the focus since the great financial crisis. As we know, interest rates were dropped to 0 in many parts of the world. They've only started coming back up again in the U.S., and there are many parts of the world that actually have negative policy rates. So what we look at is really what support the central banks are willing to provide the economy. And right now there's about as much support as you can expect to happen. The question is, will that support be taken away? And what we're seeing in the U.S. is the reasons to raise interest rates or take that support away are relatively few at this point. If you look at the chart which shows the U.S. Federal Reserve rate, they've raised rates. They recently brought rates back down after raising them to a recent peak, mostly as insurance cuts. There was some concern that the U.S.-China trade negotiations would slow GDP down to such a point that more liquidity would be needed by the market. But fundamentally, the Federal Reserve's job is to fight inflation. Well, if there's no inflation to fight, they don't really need to have interest rates as high as they might have needed in the past. And as you can see from the chart, there's only been a few times over the past 10 years that their target interest rate, core PCE, has actually breached that 2% level, and it's done it for a very short period. So the idea that the U.S. needs to raise interest rates to fight inflation in the coming year just isn't true. When we're talking about inflation, we're talking about core inflation, and that's that wage pressure that I was talking about. We're still not seeing broad wage increases across the U.S. employment spectrum. There are certain pockets that do have higher levels than others, but for the most part, wages are relatively well contained. The other thing is that no one country can really move in a vacuum. The U.S. is not going to be raising rates when the rest of the world is not. The rest of the world acts as an anchor, if you will. And I talked earlier about how when the German 10-year bond fell below 0, that pulled U.S. rates down temporarily as well. Well, that's true of central bank rates as well. And when you look in the world at the Eurozone and Japan, they still are offering free money, for lack of a better term, a negative policy rate, because they're trying to stoke their economy. They're trying to get things going and kickstart it. Well, when you've got half of the world that is still tracking at negative interest rates, it's hard to expect any one central bank in a developing world to accelerate ahead of the pack and raise interest rates. It's not good for the currency, it makes their exports less competitive, and of course it draws liquidity away from their stock markets. So we're fairly comfortable that monetary policy will remain a tailwind, not just in the US, but also in Canada and most of the developed world for the next 12 months.
And what about fiscal policy? How does that impact?
Fiscal policy is really the idea of spending money to stoke the economy, and it's really been a one-trick pony in the economy for the past 10 years, where if you lower interest rates, people will borrow money, they will invest, they will grow the economy. I compare monetary policy to oil going into an engine. If you've got an old engine and it's seized up, you need to pour some oil into it to get it going. Well, the thing is, you have to crank the engine a few times to get the oil moving through the economy. If you don't get the oil moving, you just have oil all over the floor. And that's kind of what we have right now. We have money that can't find a place to go. Because even though that money is very cheap to borrow, we're finding that certain areas of the world are not inclined to borrow it because it reflects a lack of certainty about the future. If you're not sure where things are going to be in 10 years, you're not going to borrow that free money no matter how cheap it is. And that's some of the effect that we're finding now. So now policymakers are turning to the idea of fiscal policy. So that's stimulus like infrastructure spending, government spending, tax rebates like Mr. Trump introduced at the beginning of 2018, probably introducing fiscal policy when it was least needed, when the U.S. economy was running on all 8 cylinders. What we are seeing is an increased interest around the world or in the importance of fiscal spending, loosening the purse strings. That's certainly been endorsed by Christine Lagarde, the new head of the ECB. And it's something that I think a lot of politicians in North America are also getting in front of as well. Whether it's green technology, tax cuts for middle income, or even infrastructure spending. In the U.S., they could certainly afford to improve a lot of areas of the country, whether it's a highway or bridge or what have you. Those types of things create jobs over the long term. They're not quick fixes, but they are something that can help the economy. The question that people have to ask themselves is, are the governments willing to incur the debt that might be required to fund that fiscal spending? And if you look at the following charts that come from the IMF, you can see that in the developed world, at a time when the economy's been as strong as it's been over 10 years, when we should be putting money in the bank, we've actually been growing our debt as a percentage of developed market GDP. Well, debt eventually needs to be repaid. And if it's not repaid in the next couple of years, that can be good for financial markets, but it's not necessarily good for the economy long term. So what you really need to ask yourself is, the current state of the government, how willing are they to open their checkbook and take on more debt? Now, debt at low rates isn't necessarily a bad thing. So this might be a good time to issue 50-year bonds and do some infrastructure build. But there has to be a plan to pay that back over the long term. And that's what we're not quite convinced exists yet.
So let's turn to markets now. 2019 saw all-time highs in Canada and the U.S., despite sharp reductions in expected earnings. Is it time to take another look at equities?
What you're talking about is valuation, and valuation is, in my opinion, one of the most important parts of the markets over the long term. It's really what defines the differentiation between investing and speculating. There's a saying, price is what you pay, value is what you get. If you're only focused on price, just because something is cheap doesn't necessarily mean it's a good deal. If you're looking at valuation, the most common valuation that people look at is the PE multiple. You have to keep in mind that the PE multiple is made up of 2 numbers. It's made up of the price and the earnings. And on any given day, millions of people vote on whether one or both of those numbers are right. And the reality is, they're both probably wrong to some extent. The question is which one is wrong and in which direction. So when you're looking at valuation, you need to look at the price. That's easy enough. It's on Bloomberg every day. But the question is, what is the value? What's impacting the value? And more importantly, what's impacting the price that people are willing to pay for that value? I use the analogy of a bottle of water at the Esso. It costs $1. A bottle of water at the airport costs $6. A bottle of water in the middle of the Sahara Desert, how much would you pay?
Thousands.
So it's relative to what's available and what your other options are. When you look at the price earnings multiple, there are a number of subcomponents that we can dig down into to see what really is going to drive the market. If you take a dissection of the PE multiple or the returns that were realized over the past 10 years, you can see that the PE multiple is made up of 4 different things: the revenue, the margin, the buybacks, and the dividends that are being generated in the marketplace. The PE multiple is just how much people are willing to pay for that. So if something is worth $1 and it's in demand, someone might be willing to pay $1.10 or $1.20. That's the PE multiple. That's reflected in sentiment of the market. But what we can do is, by dissecting all of these valuation metrics, we can get a better feel for something that links back to those ideas of policy and economy.
So I keep hearing the market is expensive. Is that true?
You need to compare markets based on a regional basis. Different regions of the world trade at different levels. So rather than just saying that a PE multiple of 18 in the US is more expensive than a PE multiple of 17 in Canada, we look at the relationship over time. And if you do look at the TSX versus the S&P 500, as you can see on that chart, the blue line represents how wide that gap in valuation is right now. This is when we go back to comparing the Canadian economy to the US. looking at the relative monetary policy between the two countries, and also what leverage they have to the global economy as this manufacturing reacceleration occurs. So is the S&P 500 expensive relative to Canada? Yes, but we believe with good reason, which is why we're still overweight U.S. equities.
So what makes you comfortable with 2020 earnings growth, given that 2019 was so flat?
The one thing that's giving me some reassurance is the fact that net margins, even though they rolled over in 2019, is one of those leading indicators of the onset of a recession. If you look at historically versus the beginning of recessions, which are shaded in red on the graph on screen, you'll see that net margins very typically move in waves during the economic expansion. And we've had 3 peaks so far this expansion. Now this has been the longest expansion on record. So to think that we couldn't have a 4th peak for net margins, I think would be a little bit misguided. But what's reassuring to me is that we've actually seen that fall in net margins kind of bottom out. Now what caused that fall in net margins? Some of it was tariffs, some of it was a lack of profitability in certain sectors within the U.S. that were dependent upon trade with China. Hopefully the U.S.-China trade deal will alleviate some of that. But what's really been lacking is corporate investment, and that's something that can also drive net margins. So when companies feel more comfortable about the future direction, they invest in themselves. And when they invest in themselves, they become more productive. And a more productive company is typically more profitable. So seeing that net margins have kind of bottomed out this recent downturn and are still at levels higher than we've seen in the past 3 decades, that gives me some comfort that we'll continue to see increased organic earnings growth.
Organic earnings growth. Can you clarify that a bit more?
When I speak about organic earnings growth, I'm talking about the company doing what the company's really supposed to do, which is take investor capital and engage in some enterprise that adds value to the economy, either selling more or doing it more profitably. Earnings per share, however, is a function of accounting, and the stock market works on earnings per share. You can juice your earnings per share by lowering the number of shares outstanding, and that's in fact been something that's been driving the market for some time. It's referred to as buybacks. If you look at the chart on screen, you can see that buybacks have been a significant part of the market for a couple of decades. And in fact, right now, the level of buybacks is pretty close to the long-term average of about 3%. Over the past 10 years, buybacks accounted for roughly 2.7 of the 10-year annualized return of the S&P 500. And this is just smart accounting. This is just good fiscal management. If you're a CFO and you don't have a better place to deploy your capital, you can either increase your dividend or buy back your shares. And that's just good shareholder value. So taken to an extreme, however, it can become abused. So when you see a company ramping up its debt level to buy back its shares, well, it's actually exchanging equity for debt. And debt is more dangerous because it's subject to interest rates.
So the economics look okay. Global monetary policy is a tailwind, and equities aren't overpriced. Sounds pretty good. Is there anything else advisors should be aware of or be paying attention to?
Yes, when something sounds too good to be true, it usually is. So we also look at other confirming factors, and this is the 4th bucket, or behavioral. Behavioral really encompasses a lot of things. It encompasses investor sentiment, it encompasses asset flows within the industry, and it also looks at just technical price momentum.
So what are some of those indicators that you take a look at?
Well, let's focus on sentiment. And again, sentiment can be everybody from your next door neighbor to the guy on the television. We hear about the bulls and the bears of the stock market. I'm no zoologist, but I know that if I'm in a crowd of either of them, I'm probably in the wrong place. So when there are too many bulls or there's too many bears in any one spot, that's probably a reason to be nervous. So one of the things that we look at is called the bull-bear ratio. And it's basically a survey of the market which weighs how many people are feeling optimistic versus pessimistic. And it's not an absolute number that we look at, but rather where is it versus a trend. If you look at the chart on screen, you'll see a history since 2016. This is a weekly chart, and so you can see that it's very volatile. Those lines, the flat lines over the range, represent standard deviations. How far from the middle have things swung? When things swing 2 standard deviations, high or low of an average, that's when you need to start getting worried. So as you can see at the high point at the end of 2017, you can see that the bull ratio was at an all-time high. Well, what happened? Donald Trump just announced a tax cut that, when people did the math, found that was going to lead to 25 to 28% earnings per share growth in the next fiscal year alone. So obviously people were very excited about the stock market. As you follow through 2018, if you remember the previous Christmas Eve of the previous year, it was the all-time worst Christmas Eve ever for a single-day trading, because people were worried about the impacts of the U.S. versus China trade negotiations souring. So we saw a low of bulls versus bears, so people didn't want to be in the stock market. What we see right now is that we see a pretty even balance between bulls and bears, which is ideally what you want to see in a market.
So is all sentiment market-driven?
No. If you're looking at the stock market and what's going to happen to the companies in it, there are other sources of sentiment or optimism or pessimism. And what we like to do is we like to take a step back and say, well, what do the people with the money actually think? And when I refer to that, I'm referring to consumers and companies. So we look at things like consumer spending, consumer optimism. Are people feeling secure enough in their jobs or their employments that they're going to buy a new car, that they're going to buy a new house? That they're going to start a family. Actually, it might sound negative, but one of the positive things that we look at is how many people are quitting their job to find another job. A lot of people didn't do that when they lost their job during the great financial recession. They were happy with what they had because they remembered what it was like to be unemployed. So things like that all work into consumer sentiment surveys, and you can see that the U.S. Conference Board Consumer Confidence Index, it's come down a little bit, but it is at decade highs. The U.S. consumer is feeling pretty good, and coincidentally, they're also saving more than they ever have before. Now, some people get concerned when savings is too much, but if you recall, during the great financial crisis, nobody saved anything, and people were buying mortgages when they didn't even have a job. So we've seen a little bit of a reversal in that. What concerns me is the disconnect that we're seeing between the consumer and the companies. And if you look at the yellow line, that's the Philly Federal Reserve Business Outlook Survey. And what that is a survey of CEOs and what their prospects for or their outlook for their individual companies and the economy going forward. And to see that that has been falling while the consumer is feeling optimistic, anytime you see two lines that are supposed to be based on the same thing go in different directions, you have to ask which one's wrong. What I think in this case is that we've seen a lack of optimism in terms of reinvesting in companies, and that's been reflected in CapEx numbers, where companies have been somewhat unsure of what the year to come holds. And again, this gets back to the trade negotiation. It's very hard to plan for the future and invest in a plant that will have a 5 to 10 year payback that will add value to your company if you're not sure you're going to be able to do business with the country that you sell your products to. Now that could be China, that could be the Eurozone. The idea of auto tariffs scared a lot of people. We're still waiting for USMCA or NAFTA 2.0 to be ratified. So all of these things work into how optimistic a business may or may not be. But again, if you look at this chart, it's a very volatile series. So to take this short-term downturn as gospel and an indication that the U.S. is ready to go out of business, it's simply not there. Again, it's about finding data points that make sense together and not looking at any one thing. But when you look at the makeup of the U.S. economy, knowing that the consumer is feeling strong, that's usually a good thing for the U.S. economy overall, and hence the stock market.
So for a few years, we experienced some pretty low volatility, and I think a lot of clients got used to that. Things started to feel like we could expect certain types of returns and not massive fluctuations. And now we're experiencing a lot more volatility, and I think some clients are really feeling quite cautious about the level of volatility and wondering if this is, a terrifying new situation that's going to, put them on a massive roller coaster like they've never experienced before. But I've heard that we're getting a little bit more like what normal volatility looks like.
I think that is first and foremost the main concern of any investor or any financial planner for their investors, and that's the volatility, which is commonly noted as risk in the financial markets. And I think the first thing that every investor needs to understand is that we actually want some volatility in the stock market. If there isn't volatility in a market, there isn't an opportunity to do something simple like buy low and sell high. The question is, how much is too much, and how can we take advantage of that volatility? As you pointed out, for several periods over the past 10 years, there have been abnormally low periods of volatility. There have also been abnormally high periods of volatility as well. I think it's important to understand what the normal range is. One of the most common measures of volatility is the VIX index, which is the implied volatility by options trading on the stock market. And if you look at the chart over the past 5 years, you can see that the long-term average is actually about 14.9. Currently, we're trading lower than that at about 13% volatility. Now, what does that mean? The reality is that markets change over time, and when volatility spikes or drops, you can't expect that to persist. So the logical thing to do when something is at an extreme is to look at where it's going. The important thing to understand about volatility is that it's a measure of expectation in the stock market by people that are trading stocks, and this is measured based on 30 days. The reality is that volatility in the stock market reflects changes in thinking among investors about the stock market, about the economy, about the policy, and when you see things moving at an extreme, it gives you as an opportunity as an investor to ask the question, how can this change? And as a financial advisor, how can I take advantage of that change? It might be as simple as just rebalancing your portfolio back to target. It might be introducing a new asset class or looking to a market that you haven't been invested in for several years because something about that market just wasn't right for you.
So we've covered your 4 primary buckets. What would you suggest to advisors when building their own dashboards?
When developing a framework for yourself, I think there are 3 key tenets that I key in on. Number 1, start simple. You can always go back for more. There's always more financial data. There's always more charts. So starting with the charts that you feel are most important to you. What do you absolutely need to know what's going on in the world to keep your clients' money safe? The second thing I would say is once you find what works for you, stay consistent. Markets change quickly, economies change quickly, surprises come out of the woodwork, and with that surprise comes yet another chart or a graph or a data point. If a chart doesn't make sense given what's going on in the world, but it's one of your top 10 favorites, that's when you need to ask yourself why. You don't want to be dogmatic about a process or a philosophy, but at the same time you don't want to throw it out at the first sign of trouble. So consistency is key. The third and final thing I'll say is don't be afraid to delegate. There's a saying, jack of all trades, master of none. I happen to look at charts and graphs every day on a daily basis for a living. There are a lot of things that I don't understand, that I don't worry about, estate planning, insurance needs, all these other things. I'm able to focus just on the markets. Flip that for a financial advisor. It's good to have an idea of what's going on in financial markets. But in my opinion, the role of the financial advisor is not to understand everything about every financial market. So when I talk about delegating, I'm talking about professional money management, focusing on fixed income or equities or even something like currency valuation and whether to make the decision to hedge back to the Canadian dollar, whether it's through a managed portfolio or a model portfolio that's provided to you by a particular firm or product. All in all, what it does is it frees up the financial advisor to do what really adds value to their client. Financial planning, estate planning, focusing on insurance needs if applicable, and ultimately keeping your eye on growing your business over the long term.
Well, this has been incredibly insightful. Thank you so much for spending your time with us today.
Thank you very much for having me.